Imagine applying for a loan. You have a steady job. You've never missed a payment in your life. You apply. Rejected. You ask why. The bank employee looks at the screen, then looks back at you. "I don't know," she says. The system just says no. Not she won't tell you. She can't. Because the algorithm that made that decision doesn't explain itself. Not to you, not to her, not to anyone. This is not a hypothetical dystopia. This is how credit scoring already works for millions of people right now. Your phone knows more than your bank. For decades, getting a loan meant one thing. A banker looks at your income, your payment history, your existing debt. Simple, transparent, human. That system is being replaced. Today, fintech companies like CreditLab analyze close to 10 million data points from your smartphone, with your permission buried in the terms you agreed to build what they call a behavioral credit score. Not just your income, how you use your phone, what apps you have installed, how your battery drains, patterns in how you move through your day. 65% of lenders now say they already use some form of data beyond your traditional credit report to decide whether you're worth the risk. And here's the detail that should concern you. Researchers at the University of Georgia put it plainly in a recent academic paper. Borrowers don't know what non-financial information is being used to calculate their score, or whether it contains errors. You are being scored by a system you cannot see, using data you didn't know you gave. Your friends on socials can cost you your loan. Here's where it gets stranger. A real fintech company called Lendo built its entire lending model around a simple idea. To get approved, you need trusted friends in your social network willing to vouch for you. If they vouch, you get the loan. But if you fail to repay it, those same friends get notified of your failure. Your creditworthiness is no longer just about you. It's about who you know, where you live, who's in your online circle. And this creates something researchers call algorithmic discrimination in silence. A well-documented example, mortgage approval algorithms in the United States have been found to be 80% more likely to reject black applicants for home loans compared to white applicants with similar financial profiles. Not because a human being decided to discriminate, because the historical data the algorithm learned from already contained that bias, and the machine simply repeated it, at scale, automatically, without malice, without a name attached. Picture someone applying for a mortgage in a neighborhood the algorithm associates with higher risk. Rejected before they even finish filling out the form, not because of their income, because of their address. Who's actually in control? So, who do you appeal to when a machine says no? In most cases, nobody. Because the algorithms making these decisions are protected as proprietary technology. Trade secrets. The bank cannot explain the formula. The regulator often cannot audit it. And you, the applicant, have no legal right to see what data was used against you. Legal scholars are now arguing that access to a fair credit score should be regulated like a public utility. Because right now, it isn't regulated like anything. It's a black box deciding who gets a house, who gets a car, who gets a second chance, and who doesn't. The question isn't whether technology can make lending more efficient. It already has. The question is, when the system says no, and nobody can tell you why, who exactly is in charge here? You or the machine? The banker who used to say no could at least look you in the eye. The algorithm doesn't have to. And as more of your life, your phone, your friends, your neighborhood becomes data points in someone else's risk model, the real question isn't if you'll be scored, it's whether you'll ever know how. Subscribe. New episodes twice a week. The blueprint is already drawn. The question is, are you reading it?